All right, guys, with wage data now out of the way this morning for the UK, let's turn our attention then to tomorrow morning's UK CPI data coming up at 7 a.m. UK time as well. Now, in terms of this print, it's going to be very similar in terms of tradability for CPI, like we had with the wage numbers this morning, meaning that it's not impossible to trade sterling higher on a really strong beat if we get one. What it does mean, though, is because positioning is still stretched on the long side and very close to historical stretch levels on the long side, despite the big, capitulation we had with that risk of sentiment scenario that we had, despite that big liquidation, sentiment or positioning is still massively long here for sterling. So we have seen a big move lower, which means that we could potentially trade it higher. But what this means from a positioning point of view is that the size of the beat that we would need to see to make us interested to want to trade it on the long side needs to be much bigger compared to the size of the miss that we would need to get us excited about trading it. Also from a sustainability point of view, if you're going to trade a beat, it's probably going to be more of a short-term scalp trade, where if the miss comes in big enough, it could be a little bit more sustainable to trade, again, based on positioning and based on the fact that there's still a lot of long positioning that can be unwound for sterling and obviously make it a little bit more tradable. So in terms of the numbers then, let's quickly take a look. There's going to be 6 components we'll be watching tomorrow. Firstly will be the 2 core measures, month-over-month, year-over-year. Then we have the headline numbers, month-over-month, year-over-year. And then importantly, we have the CPI services numbers, month-over-month and year-over-year. Now, you will recall that services inflation has been a key focus point and a concern for the likes of Mann, the likes of Chief Economist Pearl. And we can see why. I mean, if you compare services inflation to something like CPI year over year, you can just see the massive divergence we have there. Even with regular core, there's a huge difference between the stickiness that we've seen in services inflation versus that of regular headline and core year over year. Now, something that should be a little bit more positive for the likes of Pearl and for the likes of Mann is the fact that wages did see a decent drop lower, even though it came in just with a slight miss on the 3-month year over year and basically in line with expectations for the ex-bonus numbers. It did still show a push to the downside, which means that there should now be more of a drag to the downside in services inflation as well. But bottom line is, services inflation will be very important tomorrow, alongside the regular core and headline numbers. So we can't just watch these 4. We have to include that services, very important services number, into the equation as well. Right, so let's quickly take a look at what type of numbers then we'll be looking for in terms of a possible trade. Let's start with core month over month here for a second, and let me just bring up that forecast distribution here. Here we go. So in terms of this print, this one was a little bit of a challenge. Because we didn't really have, where is that data now? We didn't really have a lot of respondents for this, 1, 2, 3, 4, 5, 6, only 7 people or 7 analysts shared their forecast and their polls for this. So it doesn't give us a whole lot to work with, but we'll work with the ones that we have, right? In terms of what we're looking for the core number, look, anything below 0 is already going to be below the market's minimum, which is good as a miss. But what makes this one so much more sexy as a miss is that it'll be a contraction in the core month-over-month number. So if we can get below the minimum, it won't just be the fact that it's below the minimum, but we'll also be seeing a contraction in core CPI, which should matter more for the market. So they'll be aiming for anything 0.1, negative 0.1 or lower. In terms of a beat, let's keep it simple there. The prior number for this came in at 0.2. The maximum is sitting at 0.3. And since there's so few analysts that was polled for this, let's just aim for a number that's both above the prior as well as the max, which was give us something like 0.4 or higher. I think that should be good enough in terms of a beat. So let's quickly take a look then at the core year-over-year number as well. Let's just bring that on the screen. There we go. Sorry guys, keeps on jumping around this thing. All right, so let's take a look at these numbers then. Prior for the core year over year was 3.5. Now the markets are expecting this to drift lower down to 3.4. Now, if we take a look at the forecast distribution here, we can see that 3 spot 2 is already a very clear outlier on this chart. But the reason why I want to aim for something below this is that it'll obviously give us a number below the low. It will obviously, if we take a look at the chart, also give us a new cycle low. But what I like about 3 spot 1 here, let me just bring that back. What I like about 3 spot 1 is I want this thing to surprise below the minimum. Even though just at 3 spot 2 will already be a surprise. It's only 2 analysts that expected a number that low. For this trade to work, remember the markets are so incredibly long sterling right now. We've seen that big capitulation and the market's already starting to recover from it. We really want a number that comes in low enough to give the markets conviction that, you know what, maybe that hawkish pricing we have right now for the upcoming meeting, sitting at 64% probability for a hold, maybe this should be the other way around. Maybe it should be 64% probability for a cut instead. We're really looking for a number that the markets can look at and say, wow, that is a real big miss in the core number. So I think 3 spot 1 is what I'll be looking for there in terms of the year-over-year number. In terms of a beat, again, we've got a whole slew of participants looking for a 3 spot 5. So I'll be looking for a number that comes in above that. 3 spot 6, that'll also give us a number above the prior as well. So it'll show us acceleration in the core number, be above the maximum and above the prior. So in terms of the month-over-month headline, then let me just grab that on the screen as well. This one was quite messy, and the bulk of participants is looking for a contraction here. Let me just show you guys what I mean. Should be this one. Here we go. All right, so let me just bring that back. All right, so you can see what I mean. Pretty messy print. There's only 3 analysts expecting a positive number out of that month-over-month number. So the broad market's already expecting this to show a negative inflation number on the month-over-month headline. The prior for this was 0 spot 1. Broad expectation for this is negative 0 spot 1. So as a surprise here, I think anything negative 0 spot 4 or lower should do the trick. That gives us obviously a contraction. It'll be a negative number. Even if it's a consensus number, it'll be a negative number anyway. But it'll give us a negative number and it will be at the clear outlier. Obviously, if we can get even more than that, it'll be better. But I think at 0 spot 4, it's such a huge outlier on the chart. I think that should be fine in terms of a miss. In terms of a beat, 0 spot 2. Why? Above the max, above the prior. Nice and simple. Year-over-year headline then. Let's quickly take a look where that one is. Should be this one. Here we go. In terms of this one, again, you know, a print at 2% would probably have done the trick as a miss, right? Because it's a very clear outlier. It's literally only one participant out of all of these polls that is expecting a number at as low as 2%. What's also interesting about this is that the markets are broadly expecting this print to come in higher. So even though headline month-over-month, almost everybody expected it to come in below 0, with the year-over-year, everybody is expecting this to come in with a slight beat. So from 2% up to 2 spot 3. So 2 will already be a big surprise. But what I'm looking for here, again, you know, we want that number where the markets goes, wow, maybe we should flip those expectations for a hold and a cut with each other. I'm looking for a number there that will give that shock factor. And I'm looking for a new cycle low, basically. We came in at 2%. That was our prior cycle low, the prior number as well. So if we can get 1 spot 9, not only will it be below the bank's 2% target, it'll be below the low. It's already a massive outlier and it's going to be a new cycle low. That'll be a really sexy number on a dovish outcome. And then in terms of a beat, we can see clear outlier here at 2 spot 7. So I don't think we need to get that high. Remember, the prior for this was 2%. So I think anything above 2 spot 4, so 2 spot 5 or higher, that should do the trick. It's going to be a clear outlier already. It's a big jump from the prior, and it's obviously moving in the wrong direction. So 2.5 or higher, I think they should do fine. Now, let's quickly take a look then at that services numbers. And I should have them here. Now, in terms of participation, this was even worse. Take a look at this. Only 4 participants. Only 4 participants shared their views on this, which is It doesn't give us a lot to work with. I mean, baseline expectation is for it to go from 0.6 up to 0.8, so prior 0.6 up to 0.8. In terms of a miss there, again, I'm going to keep it simple, below the low and below the prior. That gives me 0.5. Prior was 0.6, the minimum is 0.7, so 0.5 will surprise everybody, be below the min, be below the prior. In terms of a beat, simple story there again, maximum expectation and market's broad expectation is 0.8. The prior was 0.6, so I'll be looking for 0.9. That gives me comfortably above the prior and obviously above the market's maximum expectation as well. In terms of services then, let me grab that. That looks slightly better in terms of what the market participation was like in terms of the forecasts. So here, 5.2, why 5.2 as a miss? It's going to be below the low. The low is sitting at 5.3. It'll also be below the prior. Now, the prior for this was miles high, right? That was 5.7. So anything below that's already going to be a new cycle low. But at 5.2, it'll give us a new cycle low, be below the market's minimum expectation, well below the prior. I think that should do the trick. In terms of a beat, 5.8, why 5.8? Remember, the prior for this was 5.7. So 5.7 might probably do the trick. For this, 5.7 will be above the market's maximum expectation, but I'm really looking for acceleration in this, right? We don't want this to come in just flat. Again, flat at 5.7 probably does the trick already, but because we know we have a slightly higher bar for an upside surprise, we really want that thing to move in the opposite direction. We want that services number, instead of going down alongside wages, we want that thing starting to move in the opposite direction. That'll probably be the most hawkish thing we can ask for coming out of that services numbers. Now, in terms of the potential reactions then, what would we expect? On a dovish outcome, pound and gilt yield downside. On a hawkish outcome, pound and gilt yield upside. In terms of assets to trade, I'm going to keep it the exact same as I did for the wage numbers, looking for euro sterling long on a dovish outcome or euro sterling short on a hawkish outcome. Why both ways? I think the pair has basically gone to neutral. I know that sounds crazy because we had such a big move to the upside, but remember, for months on end, we had so many of those market internals suggesting upside risk for the pair. And what we had in a very short space of time was, I think, the markets moving more into neutral territory in terms of those internals, basically showing that upside surprise that we expected to see. We basically got that. And where we are now, we're just kind of meandering around that 200-day moving average, and we've got a fairly mixed bag when it comes to the market internals. Some of them suggesting more upside risk, some of them suggesting downside risk from here. So as a pair, it's normally a good one to pick from a differential point of view for any type of UK data anyway. So I like euro sterling both to the up and to the downside in the case of a miss and a beat. Numbers to look for on the upside, obviously 200-day moving average coming in around the 85.55 level will be an important one to watch. Above that, it's quite a stretch to get to the implied vol high. Obviously, we'll have new numbers tomorrow, which should potentially pin us closer towards that 85, let's say 85.70 level. Thereabouts, so that could be a possible area to aim for. To the downside, we've got a couple of ones to look for. Key support coming in around that 85.20 level. Below that, we've got 80. Let's just call it the 84.90 level. Both very key zones where we've seen a lot of participation in the last couple of weeks. So I think that gives us really good levels to aim for to the up and to the downside. Now, also for a dovish outcome, pound cat short could still do. If we take a look at pound cat, what's happened is we broke through that huge level of technical support around 176. We broke through that level, we tested lower, we went right back up to that same area. Now we're just kind of sitting there. That would be a classic breakout, retest, possible continuation opportunity, right? So breakout, retest, continuation. Looking for a move back down towards the 174.50. Looks like a very viable target to aim for. The only reason why we would like this, obviously, is from a tactical point of view, not really fundamental point of view, because the fundamentals for the cat is still bearish. So pound cat downside will be mostly associated on a tactical basis with cat positioning, so massively stretched short. So that could be an option. The other one we could consider obviously is the pound Kiwi. You know, we are going into the RBNZ policy decision before we have the UK data, a couple of hours before we have the UK data, 4 hours. So if we have a, you know, very overly hawkish or overly dovish decision from the RBNZ, then we could look to pair the pound either way against that. But I would prefer to have a slightly more hawkish than expected RBNZ to push pound Kiwi lower, and then basically just trade that, you know, jump on that bandwagon, because that's very favorable from a positioning point of view, right? Because the Kiwi is stretched on the short side, the pound is stretched on the long side. So if we get a very positive Kiwi catalyst and then a very negative pound catalyst, you know, that's like the perfect opportunity that we can hope for. The only challenge on a more hawkish than expected RBNZ is that by the time that we get to the pound data, you know, we might be much lower already. Now imagine if we go into the CPI data and we're already trading at close to 207 or maybe even 206. We don't want to be chasing a move that's gone that far on a short-term basis. There's no rule to say that we can't break through that and just slice through it and continue lower, but you also have to consider things like your average daily range and how far within the realm of big surprises you might expect that thing to trade to. So that does make it a little bit risky in terms of a more hawkish than expected RBNZ. So just keep that in mind as a potential option. But again, if it's moved too much at that stage, it might be best to opt for something a little bit different, like Euro Sterling or Pound CAD. So with that said, that's just a preview for that data. As always, any questions, don't hesitate to let me know.